Howdy, my name is William Byrnes. I'm a professor of tax and international tax law at Texas A&M University School of Law. Today, I want to discuss two pertinent tax impacts of the COVID-19 Families First Act and CARES Act. I'm going to discuss the potential deferral or delay of payments for the employer's portion of the payroll tax. And secondly, I'm going to discuss and calculate an example of the Families First in combination with the CARES Employee Retention Tax Credit to present that data versus the SBA loans forgiveness program, so that a small business may understand the big picture and on its own calculate under both scenarios what will be the most beneficial result for that small business. The answer, to jump to the punchline, is that, as with all law and tax in particular, the answer is it depends. It depends on the business's number of employees. It depends on the business's payroll per employee and total payroll. And then it depends on the IRS's Notice 2020-32 that was issued on April 30th. Yesterday, that I'll be discussing in my last slide today. Starting with our first issue, the CARES Act and the Families First Act are both very important acts because they allow a tax credit for the employer. But most employers instinctually, intuitively have gone for the Small Business Administration, the SBA, Employee Retention Loan Program, because that loan program extends a forgiveness of the amount of the loan that is paid for employees' payroll, as well as a potential additional amount up to 25% of that payroll, pursuant to public notices issued by the Small Business Administration, up to 25% of that payroll for other expenses, such as paying interest on a mortgage, paying rent, paying the lease for a small shop. This isn't the seminar on Small Business Administration. My colleague Neil Newman from Texas A&M and I have delivered that in a previous webinar, and that information remains unchanged. Today, we're going to be talking about the changes that have occurred regarding the tax impact and why the Small Business Administration loan, which intuitively seems the best, may not be so for a small business. But we're starting with the deferral of the employer's Social Security tax payment. Employers are, of course, required to withhold from the payroll, from their wages for employees, several items. The first item is Social Security tax. There's 6.2% due by the employer. That is the employer's obligation. Secondly, there's 6.2% due from the employee that the employer, of course, withholds on behalf of the employee. That Social Security tax is paid over, depending on the size of the employer's payroll. That Social Security tax is paid over periodically to the Social Security Trust Fund through the United States Treasury. I'm not talking about the periodic time payments in which employers qualify for what time payment, but just to briefly summarize, there are three of them. Some employers pay quarterly. Most employers pay monthly, but large employers pay twice per week. The Social Security base for the year 2020 is $137,700. There's no Social Security tax that applies after reaching that base. But for most small businesses, the employees are earning less than $137,700. If they were earning that maximum amount, the 2020 maximum Social Security tax would be $8,537 and some cents, as you see on the slide before you. That's the employer's portion of the Social Security tax. The employee also correspondingly owes $8,537 and some change, which the employer withholds and pays to the Social Security trust fund. The employer's portion, so the employer's $8,537, the employer's allowed to withhold paying it. So you withhold the tax, but you're allowed to, instead of paying it on its due date, and just for sake of argument, let's say that due date is twice a week for a large employer. So by example, Tuesdays and Fridays. Instead of paying it on Tuesday, the employer accounts for the amount of money and then keeps it in a separate fund, which we'll see why, to be used for something, the tax credits in a moment, but keeps it in a separate fund as basically a tax-free, because it's a loan. Taxes don't count as income. Sorry, loans aren't income. It's a tax-free, interest-free loan from the Social Security Trust Fund, the U.S. Treasury, to the employer. So it operates like the Small Business Administration loan, except that there's no interest on this deferred payment of the employer's portion of the Social Security tax. It's not a large amount of money, whereas the Small Business Administration loans can be up to $10 million, although on average, they're less than $200,000 per employer. They can be up to $10 million. This is a per employee basis, a maximum $8,500 rounded. Except that, as you see on the slide, COVID, the CARES Act, was passed on March 27th. Consequentially, the period of payroll before March 27th is not allowed to be included in the deferral amount. Well, that's because employers have already paid that over. The Social Security Trust Fund isn't going to send the money back. It's been paid, and it'll remain with the Social Security Trust Fund. But the amount of payment from March 27th in payroll, for which Social Security tax applies, the employer's portion, until December 31st is allowed to be deferred. If an employee is hired, by example, on March 27th, and the employer is, until December 31st, paid $137,700, then the full amount of the Social Security tax by the small business employer of $8,537 and some change will be what the employer would normally pay periodically to the Social Security Trust Fund. That amount may be kept aside. Now, what I'm discussing, as you see in the bottom portion of the slide, does not cover the employee's portion of Social Security, does not cover the employee's or the employer's portion of the Medicare tax, which is 2.9%, split evenly. It does not cover the employee's federal tax liabilities that are withheld by the employer, but are the obligation of the employee, withheld by the employer and paid over to U.S. Treasury as a prepayment of tax on behalf of the employee. It does not cover the federal unemployment tax, which is 6% of the first $7,000 of wages paid on an employee. So the base for unemployment tax is very small, $7,000. But for many small businesses, the employee, like restaurants, where waiters are working on a minimum wage based on tips, earning tips, it's the federal unemployment tax base of $7,000 is may actually not be achieved depending on when the employee was hired. Regardless, again, for the employee's portion of Social Security, for the Medicare tax, for the employee's federal tax that the employer withholds on behalf of the employee, and for what we call FUTA, F-U-T-A, the unemployment tax, these are not allowed to be kept by the employer based on this deferral period. These still have to be paid over. So we're only talking about a potential, I'm going to round again, $8,500. But that $8,500, we're going to see in a moment with our tax credits, has a lot of value. To leverage the deferral of the payment of Social Security tax, the employer has to suffer, according to the CARES Act, an economic hardship because of COVID-19. Now, the IRS has already publicly stated that it's going to assume such hardship. And even if it wasn't, the fact of the COVID-19 hardship is established for almost every single business in the United States, because all 50 states and Washington, D.C., and the other 5 territories like Puerto Rico, Guam, each governor has issued a stay-at-home proclamation. So except for essential businesses, and even then, it's essential employees of essential businesses. So every business in the United States has a stay-at-home mandated governor order, which means that every business has economic hardship as a result of COVID-19. Now, economic hardship, as we're going to see under our tax credit definition, has some additional potential definitions, but not for this purpose of the deferral of Social Security tax. Also, it doesn't matter the size of the employer. The employer could be a small employer with 10 employees. It could be 10,000 employees. The delayment of the Social Security tax employer's portion payment is allowed regardless of size of the employer. However, you cannot double dip with a paycheck protection program. You can either take advantage of the Paycheck Protection Program of the Small Business Administration, which my colleague Neil Newman has covered in our previous webinars, or you can take advantage of the delayment of Social Security tax. Remember, with the Paycheck Protection Program, which we're going to cover in our last slide, there's a forgiveness of the loan for the payroll expenses. Yet, with the Notice 2020-32 issued yesterday by the IRS, Congress gave with one hand, but the IRS took back with the other. Now, the third bullet point on this slide is why this delayment of the Social Security tax payment is highly relevant. For small businesses or large businesses that will take advantage of the tax credits. So remember, tax credits are the default. The Small Business Administration payroll Paycheck Protection Program is only for Small businesses of 500 employees or less, or by exception, which we won't get into, but some larger employers are allowed to take advantage of it. It's very public, those that have, and they've been reprimanded by our Treasury Secretary, and they have given the money back. So the default is the tax credits. Small businesses up to 500 employees may choose the Small Business Administration loan. These tax credits may be refunded immediately through the delayed Social Security tax payment. How does that work? The employer may determine on their payment period of the Social Security tax, remember you're still paying the employee's portion, the Medicare, the federal withholding, may determine for each payment period what is up to that period the tax credit that has been earned. And that tax credit may be instantly refunded, meaning the employer keeps the money, instantly refunded from the employer's portion of the Social Security tax. But for most employers, it's going to take a month or two to understand what that tax credit will be. So between now, well, dating back to March 27th, and to the point where the employer is able to bring in their accountant or tax advisor and determine what their tax credit is at that time, the employer that is going to leverage the tax credits should delay payment of the employer's portion of the Social Security tax and use that delayed payment. Remember, keep it in a separate account. Do not mingle the funds with your business account. You still must segregate it for audit and safety reasons. Use that withheld payment to reclaim, to refund the employer the tax credit due up until that time. So by example, let's say that $2,000 per employee should have been paid to the federal government for Social Security tax, the employer's portion. And the company has 10 employees, $20,000 should have been paid over. It's held in a segregated account. The employer's tax advisor informs the employer, you, at this payment period for your next Social Security tax payment, your Medicare payments, I've determined that the federal government will owe you a tax credit of $10,000. Of that segregated account that now holds $20,000 for the 10 employees' Social Security tax payments, the employer may take $10,000 from the segregated account to refund the tax credit. Do you see what's happened here? The Small Business Administration loan is a way to cash flow the business. It also, of course, provides tax-free income through the forgiveness process. But it's a way to cash flow a business when there's no revenue. The tax credit is also a way to cash flow the business through the delayed payment on the Social Security tax. Moreover, and I'll talk about this in the next slide, moreover, quarterly, employers can file Form 7200. It's a new form, you wouldn't know about it, called the Advanced Payment of Employer Credits due to COVID-19, and get the remainder of those credits to cash flow the business. So as I mentioned, it's an interest-free loan, basically, this delayed Social Security payment. However, just like the Small Business Administration loan, it may be forgiven, but not literally forgiven as a discharge of debt. It may be offset permanently dollar for dollar against the tax credits we'll now discuss. The first tax credit we'll discuss is a result of the Families First Act, which was enacted before the CARES Act. The Families First Act created a two-part tax credit, but I'll just summarize them as one name. I'm going to call it the Sick and Family Leave tax credit. But the tax credit is for employers to be able to pay employees to stay at home because of COVID-19. So whether it's the employee, her or himself who is ill, or it's a family member of the employee, as long as it's COVID-19 related. Now, COVID-19 related isn't going to require a medical doctor's note, a test, like you're back in school and the teacher wouldn't allow the absence unless you had a doctor's note. It's not going to require that. The IRS has already made public statement that it is okay for the employer to rely on the employee's written evidence. Email would normally be the case. Email's fine, that I'm going to be staying at home because of COVID-19. Simple as that. The employee does not need to go into the medical reasons. There are federal health privacy laws. We call it HIPAA, H-I-P-A-A, HIPAA, that protect an employee's medical records and information. So the employee is not required to say, I've gone through a test and I'm COVID-19. They might volunteer that information, but it doesn't matter. The employee just needs to evidence, again, probably through an email, that's fine, that the employee is going to stay home. The tax credit is worth $511 per day. Now, most employees of small businesses probably aren't earning $511 per day, but up to an aggregate per employee of $5,110. This is going to be allowed to be summed together. So in combination with the next tax credit, the employee retention tax credit, which is also $5,000. So this $5,000, I'm just going to use the round number, 5,000. This $5,000 of potential tax credit is earned by the employer for paying wages for the employee to stay home because of COVID-19. The wages that are paid to stay home, so sick leave, family leave wages, cannot also be used for the pool for the employee retention tax credit. I'll do the numbers. You'll see it's not bad. It's just that if this is a dollar for dollar tax credit pool, the employer merely needs to spend $5,000 for the wages. And wages is not just the out-of-pocket wages. It includes the pay package of the healthcare, by example, the amount the employer spends on health insurance, by example. So it's not just literally the hourly wages, it's the package. And that's defined in the law. So that package will equal $5,000 pretty quick if the employee, by example, stays at home for the 2 months of forced homeship by governor's order. So even for small businesses, most employees are earning certainly $2,500 a month, because you get pretty close to minimum wage at that level. Okay, now the employer has built up, let's say, $5,000 of sick and family leave tax credit under this Families First Act. But the employer says, I can't pay my bills. How do I even pay the employees, my payroll? How do I pay my light bill? How do I not get kicked out of my shop? How am I paying my lease payments? So I mentioned in the previous slide, one, the Social Security withholding the employer owes, that can actually be used to refund right now the tax credit. So that becomes part of the employer's cash flow. Secondly, the employer may quarterly file the last bullet point, Form 7200. Form 7200 is a one-page form. It's very simple. Now, you're going to need a tax advisor or an accountant to calculate the amount. The form's simple. It says, how much tax credit do we, the federal government, owe you for sick and family leave? How much tax credit do we owe you for employee retention? How much money have we paid you already for these credits? And so like the delayed payment on the Social Security tax, what can we credit against? Okay, whatever that balance is, the negative figure, well, I paid over my Social Security tax. I didn't, delay the payment. So and I have $5,110 per employee. Let's say I have 10 employees, that'd be $50,000 potential tax credit. The federal government, U.S. Treasury, will write you a check for $50,000. It'll be a direct deposit because, of course, small businesses have direct deposits set up because both paying your Social Security tax is required by direct deposit. And receiving that refund for this tax credit will be direct deposit. So through Form 7200 plus the delayed payment of Social Security withholding will allow an employer to cash flow their business as if receiving the Smaller Business Administration loan. Now let's talk about the second tax credit. So the first tax credit was the Families First Act credit of stay-at-home. The second credit is employee retention tax credit. This one's a bit more complicated. The stay-at-home was you spend $5,000 to keep your employee at home, you get $5,000 credit. Simple to understand. This is a little bit more complex, so a bit more slides. Now, like the Families First credit, the stay-at-home credit, you can offset this credit against the delayed payroll tax obligation, the Social Security tax. The maximum credit is a very similar amount. It's $5,000 per employee. Remember, the other one's $5,110. So let's use a round number, 5,000 and 5,000. Combined, $10,000 potential credit per employee to keep them on your payroll. Half of that credit to keep them at home during the stay-at-home period. The other half of the credit to keep them on your payroll after the stay-at-home credit runs out. Okay, the tax credit is calculated based on 50% of W-2 wages plus medical. That's similar to the Families First credit. So it's not just the wages, the hourly pay, it's the hourly pay as well as the medical amount, the payments for medical. And the W-2 wages includes not just, again, the hourly amount, but also, by example, the Medicare tax, which is medical expense, Medicare tax amount. So to achieve a $5,000 per employee maximum tax credit, the employer needs to spend $10,000 on the payroll of the employee. So in combination with the Families First tax credit, the employer needs to spend $15,000 between the stay-at-home and the retention credit. Now, here's an important note. It's an employee retention tax credit. So you need to retain the employee, but I've already let all my employees go. That's the obvious question. It's okay. You can hire them back. You got to hire them back before June. So you have a month from this is May 1st. So you have a month before this webinar to bring your employees back on the payroll. The stay-at-home credit, as I said, may be used in combination. You may earn this employee retention tax credit by also paying your employees to stay at home. So after you've reached $5,110 on the stay-at-home credit, you're still keeping your employees on the payroll, but they can't come into work because you're shut down. You don't have any customers. It's a stay-at-home order, or you're a restaurant, you can't get food because the food distributor is not open yet, or the shopping mall you're at is not open yet, or customers are just not feeling safe to come to your business yet. It doesn't matter why. You're able to combine the two credits so that you get your maximum. Again, let's use the round number, $10,000. Now, there are some anti-abuse provisions, if you want to call it that, but calculation provisions that state, by example, oh, your wages can't all of a sudden double this year relative to last year. So you got to look at 2019 wages to determine what your wages are. You got to look at 2019 number of employees to determine what your number of employees are. So by example, if a business has 150 employees in 2019, and on February, let's go, half the employees. So, now it would fall under a very small business, less than 100 employees. You don't get the small business treatment, because you'll see why that's relevant in a moment. You have to count it as if you had 100, the greater than 100 employees. So which employers qualify for the tax credit? So again, you have to have been partially or fully suspended by government order. That's all employers in the United States, because every governor and all territories issued a stay-at-home orders. But there are two more calculation rules. One, if your business's gross receipts in the quarter, so first quarter, January through March 31st, are 50% less than last year's gross receipts, you're impacted by COVID-19. I don't think you're going to have to get there. All businesses are there, almost all businesses in the United States, maybe not pizza delivery per se, but I think even them, all restaurants were impacted by this. The rule is if you are fully or partially suspended because of government order, and the government orders in all states, all cities, municipalities, suspended business. So I think you're covered under bullet point number 1. But there is bullet point number 2 to be aware of. And finally, bullet point number 3, when do you stop building your pool for purposes of the employee retention tax credit? If the gross receipts for the quarter are 80%, so they've rebounded from, let's say you have no gross receipts, like March and April and May, you have no gross receipts. Okay, when the quarter gross receipts are 80% of what they were last year, that's when you're considered to be back in business, rebounded, and no longer can you add to your employee retention tax credit pool. But because the maximum amount of that pool is only $10,000 of wages, because the maximum tax credit is only $5,000, you probably, most employers aren't going to get there. Certainly not until the fourth quarter of this year, maybe for Christmas season. But as it stands now, for May 1st, most businesses aren't going to be able to open until June. And that puts you at the end of the second quarter. So in the third quarter, when businesses are just getting back to work and rehiring employees, if that's the case, or having new supply chains to acquire the food and so forth, you're probably not going to get back to 80%, unfortunately, of last year's third quarter. So, and again, third quarter from July 1st until September 30th. At fourth quarter, maybe you'll achieve the 80% status. But by the time you've reached September 30th, you've probably paid your employees more than $15,000 in wages to achieve the maximum of both tax credits. So the maximum $10,110 of tax credit. Now, I mentioned small and large employers. Now, like in tax, the Small Business Administration has different definitions for different purposes. In tax, small business can mean different things for different Internal Revenue Code provisions. For the Employee Retention Tax Credit, it has its own meaning. Employers that have up to 100. So 100 and less employees that are full-time employees. What's a full-time employee? On average, 30 hours per week. Well, on average of what time period? Remember 2019. You look back a year. So if for your 2019 period, you're an employee average 30 hours a week, or they're a new employee, okay, are they working 30 hours on average a week, then they're a full-time employee. And for 100 and less, you're allowed to include in your wage pool to get to this maximum $15,000 of wages, which extends you the maximum $10,000 tax credit. You're allowed to include in the pool for the employee retention tax credit all the wages paid until December 31st, subject to not reaching 80% of the revenue of last year's quarter. But if you're over 100 employees, you can only include in your employer retention tax credit the amount of wages paid for your shutdown period, for the period when the employees are not able to perform services for the business. Because the law says services for the business, if the employees are working from home, so they're telephony, used to be the old word, I guess the new word is zooming in and doing their, using SharePoint or some other Citrix-based system to do all their work for the business, then they're still laboring for the business. They're committing or executing services for the business. They're not stay-at-home employees. That does not qualify for either Families First or the employee retention tax credit if the employer has more than 100 employees. So for small businesses, it's easy. For large businesses, it's a little bit harder to determine when the employee is and is not doing services for the business. And it can be very ad hoc, like for the next 2 weeks, the employee is told, listen, you can't work for the business because we have no business, because we have no clients, because of the shutdown. Oh, we now have some clients, so you're going to work for the next 2 weeks. And then for the next 2 weeks, again, they're back home, and they're still home, but they're not able to work for the business because there's no clients. So it can be very ad hoc and add complication to the process. Again, it's something that the tax accountant, the tax advisor will have to work out for the small business. And now this is the final slide. Let's talk about the numbers. I want to give you an example. It's a broad example, so I don't have all the factors built into it. It's a broad example just to show, to illustrate that it is possible that the tax credits are going to be better than the Small Business Administration loan with forgiveness. Why? Yesterday, last night at 5:30 p.m., the IRS issued Notice 2020-32. Notice 2020-32 states that a small business that takes out the payroll protection loan and then is given forgiveness, so cancellation of debt, is given forgiveness for that loan. Under the CARES Act, that loan forgiveness is not gross income. The employer does not include the forgiven amount in the employer's Schedule C. However, Notice 2020-32 states the employer must deny itself any deductions that the loan portion that was forgiven were used for. So said more simply, if I borrow $1 million and I spend $1 million on wages, the $1 million I borrowed and spent on wages, I can ask for forgiveness from the Small Business Administration, and I'll have no tax consequence. You still owe the Social Security taxes and the Medicare and so forth. That's the employer payroll tax. But on the federal income tax, there'll be no tax consequence. But I lose the $1 million of deduction for the payroll. You're going to say, well, that's a double dip anyway. I mean, I don't have any tax consequences. There's two very good arguments, you know, for and against. I'm on the side that this is a very bad notice, that this notice is, I don't agree with its logic. I think the notice is erroneous, we would say in tax law. I think the notice should be withdrawn. Regardless, the notice is a notice and we have to act like it's law. So these numbers are going to work through the notice as if it's been enacted into law. A business, small business, has 100 employees in my example. The business pays those employees, whether it's, you know, it would say it's 101 employees, so it's a large business for purposes of the tax credit, doesn't matter. During the applicable period of time, the employer paid $15,000 of qualified wages, so wages and medical expenses, the health benefits for the employees. Now, 15,000 times 100 employees is going to give us a payroll of 1.5 million to keep it simple. That's going to allow us our maximum tax credit of families first, stay at home, plus employee retention of $10,000. Again, I'm simplifying it. It's literally $10,110, but $10,000 tax credit per employee. Assume a federal effective tax rate of 35% for our small business employer. So they're not an incorporated C corporation. I don't want to complicate the matter. They own it as an LLC, a sub S, or they own it as a proprietor in their own name, the small shop. And we're ignoring the potential 20% business income deduction that exists for the Tax Cuts and Job Act years. That's called IRC Section 199A. If you're interested in IRC Section 199A, my co-author Robert Blank and I have several webinars and dozens of articles explaining it for non-tax people. And I encourage you to look at those through our service called TaxFacts, TaxFacts, TaxFacts. Okay. So the employer in this scenario on your slide has a $1 million tax credit owing, and also a $525,000 tax deduction. How did we determine the $525,000 tax deduction? We took our payroll at $1.5 million and we multiplied it by our federal tax rate. So we're using 35% for our example. I know the highest rate is 37%, but generally, because it's graduated, it's a progressive rate system, as we call it. You pay a smaller rate on a smaller amount of income until you work your way up. Okay, so regardless, it's going to be somewhere between 30% and 37% effective tax rate for our business people. That includes the IRC 199A you see on the screen. Okay, so the overall benefit for the small business using the tax credits in this scenario is $1.525 million. That's $1,525,000. And I'm, again, keeping it simple, not bringing in other factors. As long as the business delays payment of the employer's Social Security tax and also files Form 7200 quarterly, the business will be able to address its cash flow needs through clawing back the $1 million tax credit as the wages are spent, but on a quarterly basis, because 7,200 is a quarterly form. So the Small Business Administration loan is a lump sum amount, whereas the 7,200 form allows a quarterly cash flow. But the business doesn't need, I'm just going to say, let's say the loan from the Small Business Administration would be $1.5 million to pay payroll. So the business doesn't need the $1.5 million lump sum today to cash flow for the entire time. It needs the money to meet its payroll. It's not a perfect comparable to comparable or amelioration, but it's better than nothing. The business is still able to cash flow itself through the tax credits by using them against the Social Security employer's portion and against and by having the tax credits refunded directly. Again, it's a direct deposit using Form 7200 quarterly. So it's not, again, a perfect solution, but it's a pretty good solution. Moreover, the CARES Act, just for 2020 losses, allows those losses to be clawed back against previous tax years. So taxes that were paid, by example, on my slide 2019, if there are tax credits still remaining on the books when we reach 2021, those can be used to offset against any liabilities that would be owed in 2020. But because most businesses are going to be in a net operating loss for 2020, the business will file Form 7200, you see on the screen, and get back all those tax credits. So the business isn't going to be owed any tax credits once we reach the end of the year, because it won't know potentially all of its tax credits until December 31st, when it's made its final wage bills. If it's reached $10,110 per employee, it's maxed out on that employee. But some employees may be hired in June, and so by the end of the year, you've finally reached your potential tax credit for that employee. The CARES Act allows the business to take that loss for 2020. Let's just say the loss is, use an even number, $1 million. $1 million loss for 2020. Allows the business to take that loss and apply it to 2019. Let's just say, for sake of argument, the business made $1 million in 2019. The $1 million of loss of 2020 may now be offset against the $1 million of earnings for 2019, and thus any tax paid on those earnings for 2019, if we're using a 35% tax rate, on the slide, would be $350,000 tax. That tax is refunded to the taxpayer, to the small business. Mind you, this is occurring in 2021 because you have to file your tax return, right? So you have to file it by April 15th, but it's going to encourage a lot of small business owners to file the first day of the tax season, because that's cash flow. That's going to help the small business stay alive. The reason I bring that up is Notice 2020-32 denies the tax deduction for the payroll. Thus, the small business does not get the benefit of that payroll deduction, and thus may not have any net operating, or have a very small net operating loss for 2020, because the wages, and up to 25% of the wages, I mentioned this when I opened up this webinar, up to 25% of the wages may be used for rent or lease expenses. That money's forgiven, no income tax consequence, but no deduction. Thus, maybe very small or no operating loss for 2020. Consequentially, no net operating loss to carry back against 2019 and receive that cash flow, that tax payment of 2019, to claw it back, to receive it back in our first quarter of 2021. Every small business will need to do the numbers with their tax advisor or tax accountant themselves, but I think what you're going to find is that because of the IRS Notice 2020-32, that the difference between the cash flowing of the Small Business Administration with forgiveness alone and that of the tax credits is going to be minimized, maybe zero. And in fact, in some situations, the example on the slide, the small business may actually be better with the tax credits as opposed to the Small Business Administration loan. Again, I do not agree with the notice, but the notice is the official position of the IRS as we stand May 1st. I hope the notice was withdrawn later on, or I hope Congress addresses it in what is presumed to be a fourth economic stimulus package being currently discussed. But if neither of those happens, Congress does not address it and the IRS does not withdraw it, litigious litigation against the IRS can become expensive. So if the notice is allowed to stand and the deductions for payroll and other expenses that the Small Business Administration loan was used to pay are denied, again, and I'll end with this conclusion, the small business may be better off with the tax credits. Do the math through your tax advisor or tax accountant, and thank you kindly for your time. I encourage you to look at Robert Blanc and I's, we have about 15 articles describing both the Families First Act and the CARES Act as it applies to small business owners. And those are publicly available. Just Google us, or you can subscribe for a very small amount to TaxFacts, and you'll have, I think, about 8,000 questions. We do it in a Q&A format, 8,000 questions answered for small business and for investors. I appreciate your time, and you can always reach out to me if you have questions. And I'll at least, I don't advise clients, but I'll at least provide you the correct websites to look at for your answers, or it can refer you to advisors in the field. Thank you, guys.